Yeah, it's been a big effort. And we've, Brad and I have been over there a bunch, and, we're trying to get really European family offices, but mainly London family offices to invest in U.S. oil and gas. And it's been kind of neat to see that happening. So there's been a lot of money coming over. INEOS is probably the most extreme example. I think they've invested about $3 billion or so in the U.S. oil and gas space. But we've gotten good traction, and we'll keep going over there and see if we can get more families to invest in the U.S. oil and gas space.
So what's that conversation like? I'll play like I'm British. I'm dating a British girl, so I can play British. Kind of what's the pitch in terms of, and maybe when you're telling me kind of the base of the pitch, differentiate it with a typical U.S. investor.
Yeah, I'll kind of back up to so Brad and I raised a bunch of money in the past from private equity funds like Kane Anderson and others over the years. And I guess during COVID, we kind of saw the slowdown in private equity fund investment activity. And we still wanted to be able to provide that type of capital for our clients. And so we had set up at Stephens a product group, just a financial sponsors coverage group to cover family offices because, we were doing so much with family offices, mainly selling family-owned businesses. And so we staffed it with a guy named Mickey McFarland. Again, John Stephens was real active with that group. Mickey set up a team, and they cover, I think today, about 400 family offices. These are generally family offices that can invest 20 to about 200 million per deal. So large family offices. And, when we saw the slowdown, we had no idea how relevant it was to our space. And we got with Mickey and said, hey, why don't you look at your list, maybe ping them, ask them a handful of questions, but try to get to the bottom line if they would invest in oil and gas. And over time, they developed a pretty good, kind of subset of families that like oil and gas and want to invest in it. And the thesis is, oil and gas isn't going away. The energy transition is going to take longer than people think. There's a historic low on, where cash flow multiples are in A&D deals, and public equities, just kind of where they trade. And so that was kind of it. And families can hold for longer periods of time and, like to be contrarians and invest in space, in sectors that, have some kind of dislocation. And so we had a lot of luck with, getting those families to look at our deals and in some cases invest in our deals. And then we, to Brad's point, had set up this London family office, and we thought, well, let's, there's some London family offices or European family offices on Mickey's list. Let's go see if we can have any luck with those groups. Same backdrop. The only thing I'd say is their exposure to kind of the importance of hydrocarbons is more extreme because, you had the, Ukraine, the Russian-Ukraine war. You have parts of Europe getting cut off from Russian gas. And so they can see firsthand the importance of hydrocarbons, right? And that was it. So when we would go over there, we had a whole deck on, hey, here's kind of why you should invest in U.S. oil and gas. And most of them just said, we get it. We want to invest in U.S. oil and gas. And in most cases, they already had started investing in U.S. oil and gas. So we were really just kind of carrying it forward and trying to develop those relationships to show them, specific opportunities that we're acting as banker on.
Yeah, and to kind of to add to that, so as Keith mentioned, you had John Stephens and Mickey McFarland, a couple of our other guys, basically formally stand up our family advisory group probably 10, 11 years ago. At that point in time, the families that were under that coverage group really wouldn't look at oil and gas deals. So if you think about when they stood it up, that's 14, 15, 16, and what oil and gas did in that 2-year window. So
way too painful to even talk about today. But go ahead.
Exactly. Yeah. Anyway, so you have that wealth destruction, if you will, in that 2-year period. You have the other verticals that are on fire, whether that's tech or pick your other vertical. And so the families at that point in time really wanted to invest in other verticals. I mean, they're reading and hearing everything that we are as well. So that point in time when we actually stood up the group, Keith and I were showing them opportunities. And frankly, not getting a lot of interest because they're, every deal's got to compete for capital, right, in other verticals. So if we'd taken a deal and it showed, this kind of return dynamic and this risk, et cetera, and having to compare that to what they're already in, energy deals were struggling to some degree. And then piling on to what happened in 14, 15, 16, then you had kind of the ESG phenomenon, capital obviously fleeing the space. So it's been a pretty lengthy effort,
and it was worse over there. ESG,
yes,
as bad as we thought it. That's the one thing I've picked up going over there a lot. I mean, they truly believed Greta Thunberg.
Right.
I mean, I think over here we paid lip service to it. Over there, they truly believed it. I mean, they like literally staring. They would rather buy natural gas from Putin than frack themselves,
I think that still somewhat exists today too.
Yeah.
But anyway, so it's been a lengthy effort. Now, obviously, with higher commodity prices the last, really 4 or 5 years, that kind of dying a little bit. Now the families are absolutely wanting to look at a number of, oil and gas deals, mineral deals, midstream
transactions. Does the FIRPTA
transactions.
issue still exist?
It does exist.
Tell people what that is in case they haven't heard.
Yeah, well, I'll say this. We typically are targeting groups that already have a vehicle set up over here.
Okay.
It's not necessarily an oil and gas vehicle. One family office we're close to is a big real estate investor over here. And so I'd say that generally the groups we're meeting with all have that issue figured out. I don't even know if I can speak to it, but they don't have tax issues.
So it doesn't become an issue. And I'll probably bastardize this up, but basically FIRPTA is you buy a real property interest and 25% of your gain the U.S. government keeps. Now, if you have investments there that you can get tax credits for, then to your point, it's not an issue. But doing a standalone first-time investment in the United States, we always found that whacked about 300 basis points off your returns, because there's some games you can play where, hey, you invested 100, but 50 of it's really a loan, and you got paid a 10% interest rate. Well, that's not subject to the FIRPTA rules, but the other 50 that is. So we always found it kind of cut 300 basis points off.
Yeah, and we haven't. No, it's come up in a couple meetings, but for the most part, like I mentioned, these are kind of these groups have vehicles in place, and they have tax personnel that have that figured out. So we're trying to target groups like that where we don't have to explain it.
Yeah. To Keith's point, most of these groups have maybe not been investing in energy here in the U.S. for a long time, but they've been investing in other verticals in the U.S. for a while. So they usually have capital domiciled here in the U.S. and they just basically invest out of that vehicle. So it might be a European family office, but the money's already here.
And I think one thing too, that we've learned, to Brad's point, there was a period where these families didn't do well, or energy didn't do well, and it wasn't good timing for us to go after that capital. Really what's evolved in our space is continuation vehicles, just recaps of existing portfolio companies, or maybe a recap of around a couple assets in a private equity fund. What we've learned is the families really want to underwrite around a deal. They don't like, for the most part, kind of blind pool risk or a lot of blind pool risk. They want to underwrite around a deal, invest, of course, at attractive terms, for themselves. And they also tend to kind of invest through syndicates. And so,
Right.
If you have, call it a $250 million.
We'll do this real quick because mom's watching the podcast. Tell mom what a continuation vehicle is. And mom's pretty sharp, but she doesn't know oil and gas.
So all a continuation vehicle is just a recap of an existing portfolio company. And you're just setting up a really kind of a new entity that's going to basically buy assets from the existing private equity fund. And so you have new investors that are essentially taking out the old investors. In a lot of cases, they're kind of East and West Coast endowment funds.
So I'm the private equity firm. So I'm in effect, I own, call it 95%. Management owns the rest of this company. but it's really my LPs that own that 95%. Right. You're saying they come in and am I GP of the new entity too?
Yeah, usually the GP will roll into the new vehicle.
So any investment I had, if I'm getting paid carry or whatever, I roll.
Yeah, you'll roll it, and then the LPs, your LPs will get, for the most part, get cashed out. Now the LPs do have the opportunity to roll as well, or they can get cashed out. So they can go usually either route.
Because that's the keep it fair. You're in effect selling this to yourself. Oh, if you think I'm selling it too cheap, why don't you just roll?
Right.
Okay.
Right.
The thing I would say to that is, in a CV, whomever owns the existing company, pretty much everybody has that option. The point being is that I don't think there's a cookie cutter, here's what all CVs look like. So I think in some cases you may have a GP fully roll. In some cases you may have a GP that says, hey, look, I may want to take 20% off and roll 80%. So it really just kind of depends on each deal and really each desire of each GP and LP as to what they want to do.
So drilling down into those entities, because I think those have been going on for a long time. So you kind of have a body of work in effect. You're right, each one's individual, but there's some commonalities there that the market has sort of accepted. So, hey, LP, you get $10. If you don't want the $10, roll it, and you get $10 of credit in the new entity. So that kind of keeps that fair there. The new investors generally, hey, GP, we want you to have skin in the game in the new one. So roll all of it, roll 80%, whatever that gets negotiated. And I think the market's bought off on that. Generally speaking, that's fair to everyone involved and all. I think the only criticism, the slight pushback you hear is, well, okay, just because you're stopping, just because this private equity fund that owns the company isn't paying management fees anymore or paying lesser management fees, and you're selling and extending your runway on management fees, are you thinking with your management fees, or are you thinking with my, my dollars? But even there is, okay, well then just take your $10 of cash or whatever. Yeah.
Look, what I would say is that the CV or the CV process, to your point, has probably evolved over the last 4, 5, or 6 years. And what I mean by that is that if you're an entity and you've got your shareholders that are under the tent, and you truly are trying to reshuffle the decks and get new investors who want to think long term with the GP and management, I mean, they're going to scrutinize everything on the buy side. So all of those line items that you would see in a typical term sheet, I mean, those are going to be discussed and thought through and also negotiated. So in our opinion, from where we sit, we think the CV process has evolved to look almost more like an outright sell-side process. So any of the transactions that we've either been working on or are currently working on, if you look at our materials and look at how we're presenting the opportunity, it actually looks like a sell side. We're just not selling control.
Yeah, and I think
I'll let y'all in on a little secret. Back in the day, the private equity fund, like entity number 5 would just buy out entity number 2, and pay, entity 2 would pay carry. It was, yeah. LPs got wise to that.
Right. Yeah, I think I guess there's a couple other variables too that, I think the processes have gotten a little more efficient. They've been around for a long time. I think Crown Quest was a continuation vehicle before people called it that.
Right.
And so they've been around for a long time. There's been a handful in the energy space that have gotten done here in the last, couple of years. There's a number of them that I think a lot of people are aware of that are in the market. And then, just as we've noticed kind of in our processes, when you're putting our first investor list together, it was kind of a lot of family offices that didn't really maybe kind of know what this was, and we had to do some educating. Now they've seen more deal flow. There's also a number of institutions that have popped up that all they do is focus on CVs. And so Brad's going to talk about a deal here in a second, and it was kind of a roughly 50-50 split on committed capital between institutions and family offices. And We think on the larger deals, that's going to probably continue to be how they play out. I mean, you never really know, but we do think family offices will be kind of an important piece of the puzzle.
And are there value? Okay, so I'll say this as a statement, but it's really a question. Opine on this. I always believe in oil and gas. A strategic can pay more than a financial player. I mean, if for no other reason, you can just get rid of G&A.
Mm-hmm.
Do valuations ultimately kind of shake out similarly? Are there constraints around certain companies, i.e., we just can't sell to a strategic these days? How does the market kind of grapple with those type issues?
Right.
Yeah, look, it's a good question. What I would say to that is every situation is just completely different, right? I mean, if you're talking about core assets that are in a core of a basin that are hard to replicate with a good management team, you're going to get really good valuation. And if you're in a tier 1A or a tier 2 basin, and maybe there's a little bit more risk or there's some nuances to the deal that make it a little more complex, obviously valuation is going to suffer a little bit compared to, say, either publics or whatever current M&A markets are dictating. So look, we've all been doing this for quite a while. To me, it just kind of year in, year out, it really does depend on the asset base, what you can do with it, where is the asset base in its life cycle, and what are the next 2, 3, 4 years look like as it relates to the asset base and what the company can do with it.
Well, and I mean, I think if you're John Farber, you're sitting there going, well, I don't want to sell Crown Rock today, but I know that I have investors that do want out, and I get it. They signed up for a 10-year private equity fund, and we're going to hold this 18 years.
Yep. There's always, in a CV, there's always, generally always real tangible upside that you just aren't going to get paid for in the A&D market. We have, I think part of the answer to your question, most of the CV activity has been in kind of secondary basins. So Mid-Con, Rockies, Marcellus certainly, where there's more of a active A&D market, and there's maybe just a longer buyer list of really credible, well-financed buyers, like the Permian. You've seen fewer deals there. And I think that'd be because you'd have too big of a valuation disconnect between a strategic sell and a CV, so you can't really do a CV without kind of some conflicts coming up. But in the other areas, I think that bid ask is a little narrower, so you can do a CV. And then, again, the CV valuation theoretically can probably come in a little lower than a strategic valuation because you have a go-forward plan. You have identified drilling opportunities that you're not getting any value for maybe in a sell process, but, they're part of the CV model. And you can kind of, investors that roll can kind of look at the return potential, and they should, maybe be okay with a slightly lower valuation. Again, if it gets too big, all of this falls apart and you probably just have to sell. But if it's narrow, the CV option becomes kind of prevalent.
Yeah, I mean, I guess at the end of the day, it's going to dinner with your three brothers and going to your second favorite restaurant. I mean, at the end, if you think about it, it's kind of like, all right, if you really hate the food there, go ahead and roll. Go ahead and take your cash. If you don't hate the food, it's not your favorite, go ahead and roll. And so I get it. No, that probably makes sense. So tell me about this deal. Who was it?
Yeah, sure. So it is a mineral and royalty company named MAP. Company's been around for a long time. I would argue that they're probably one of the first aggregators of mineral and royalty assets that took in institutional capital. That they basically the former management team who is still involved in the story, started raising capital in the late '80s. Kept raising, more
capital. So what city are they out of, and who was the CEO?
Yeah, so the CEO today is a gentleman named Bobby Wegener, and he's got a team around him. He's located in Oklahoma City. The founder was Jane Woodward in Palo Alto.
Oh, yeah.
And so it was Jane, and then she brought in a partner pretty soon thereafter named Steve Hall. So it was really the two of them that kind of ran it out of Palo Alto, and then they they partnered with a few gentlemen in the Oklahoma City area. So they basically raised capital, on the coasts, but they really knew that they needed to partner with, people that knew the patch, boots on the ground. And so their strategy was to, go partner with people that were in specific counties in Oklahoma, Texas, Louisiana, and kind of pick your area and basin. And so they, basically kind of grew the portfolio over the last 35, 40 years. From where we sit, it's probably one of the biggest, privately held portfolios in the country. Never really sold many assets. I think along the way, they probably monetized a few things here and there, but for the most part, have a very sizable portfolio in all the active basins that, you'd want a portfolio to have. And kind of like what Keith was talking about earlier, you've got a company that is kind of at an inflection point. They want to grow. They see some growth avenues. They've got a few partners that, are thinking about, should we stay in the deal or is it a good time for us to exit the deal? Look, the partners that had been in with them had been a part of MAP for, in some cases, 25, 30 years. And really obviously taken distributions, over that period of time, but never had a true, monetization or liquidity event.
Right.
So it just, after kind of having conversations internally, they felt that it made the most sense to do a continuation vehicle, felt that it solved the problem of, okay, some shareholders want to keep going. Some shareholders are looking to exit for whatever reason, maybe specific to them.
Was there a Stevens pitch book saying continuation vehicle versus going public? Did y'all look at that, or was that even an option?
No, not really. No, look, the company has been private for the last 35 plus years. They, did not really have a desire to go public. Just wasn't something that they wanted to do.
They didn't want public.
They didn't want to sell the company. Assets, in their opinion and our opinion, they're impossible, to replicate. Probably have done thousands of acquisitions over the last 35, 40 years. And then they also saw obviously some good things, here on the horizon as it relates to the asset base, particularly kind of in the core 3 or 4 basins. So they felt the CV route was just a good solution for all shareholders. And as I mentioned earlier, and same with Keith, we treated it as an outright sell side. We just weren't selling control. And so anyway, so the family offices were, kind of right place, right time in terms of when the opportunity, kind of came about relative to kind of our view of how family offices are looking at the space and showing interest in the space. The other thing I would say too is just, if you look at all the asset classes within conventional energy, we think that the mineral and royalty space is great for family offices. You've got a kind of growing underlying asset base because they have a lot of wells that continue to be drilled on their property, but at the same time, they provide a very nice yield, consistent yield, and have been for the last 3 decades.
Yeah, and Chuck, we think there's not a whole lot of stats out there. It's kind of word of mouth on other CVs that have gotten done in the past, but if it's not the biggest one that's been done, it's certainly up there.
Was there a number announced?
Yeah, can you say? Or?
It hasn't been announced, but it was, well over $1 billion deal.
Wow.
And then
that's a lot
half of that roughly is family office equity.
Cool.
So that's I think last time we came on, we were talking about, we kind of mentioned this deal of no names, but we kept talking about, hey, family office equity, it's coming around, and here's $500 million. So, that's pretty substantial. One other thing I'd say is there was real close coordination with our family office advisory group. They they cover mainly non-oil and gas family offices. And so several of those participated in this deal, and some in very large amounts. So we got to see that integration and the value add coming from that group firsthand in this deal.
Yeah, the other thing that was important on this deal, and then other CVs that we've either seen that we weren't a part of, and then ones that we're working on as well, is the growth kind of aspect to it. So this was a situation where they were growing organically, but they saw some kind of, low-hanging fruit as it relates to acquisitions that they could pursue. And with the shareholder base that they, had in the previous entity, they learned that just a lot of those shareholders weren't really interested in growth. And so by conveying the assets into a new co, changing the structure a little bit, as a part of the deal, we raised several $100 million of capital, over and above kind of what it took to get the deal done. That's basically going to be as a part of this transaction. So now MAP will be able to go after acquisitions that they've kind of been warehousing, if you will, or at least thinking about, and can pursue those over the next couple of years.
So kind of, the way my understanding of the continuation vehicles is generally you go out and let's say I'm trying to sell, let's go to a secondary offering of a private equity fund. So I'm an LP, my marks are 100. We go out and usually the bidding is 75% of marks, 80% of marks or something.
Yep.
Do you guys go out with a mark when you're saying that? Or, the term sheet, the price is X, or is it traditional bidding type deal of give me your indication on interest? How does that work?
So again, I think every process is different, but what we did was, and not only in this deal, but all the other ones that we're working on, is we do the typical work that you would see in a fairness opinion, right? We, build our upstream database, build our NAV,
Right.
Have all the various categories kind of modeled out over the next 10, 15 years. And then that kind of be the anchor of the valuation. And then, of course, we triangulate that with where are public comps trading today, where have they been trading. We also triangulate that with the M&A comps. So we kind of come at the market, if you will, with kind of a preloaded fairness opinion as to, look, here is where these things
got a sticker price on it.
It's got a sticker price.
Most of them do.
Yeah. Some have a sticker price. In our case, we, talked to what we thought were the appropriate lead investors, talked about valuation and other terms that were important to the deal and important to the process. But yeah, to Keith's point, a lot of them do come out with a sticker price, and then there's some that don't. Really depends on kind of what ownership and management want to do.
Yeah, and we typically, they did, Brad's right, they all kind of vary because there's examples where there's not a price in there for various reasons too, just because of some sensitivities or what have you. But you give them all the information to kind of, fill in that blank, and then you're getting that same indication from other groups, and then you kind of, that leads to you picking a horse as an anchor. And so we'll go, in a lot of cases, get an anchor that it varies, but it could be an institutional group, could be a oil and gas family office, just the type of family office that other families will follow because of their experience in the space. We've done that. And then we usually, once we have that anchor locked up, we kind of get with Mickey's group and kind of round it out. And it doesn't have to be with all non-oil and gas family offices. There can be, oil and gas family offices that are part of the syndicate too. But it is kind of nice to see these large non-oil and gas family offices kind of stepping up and investing in the space.
So does the VDR on this look like a sales side? You got reserve reports, production history, decline curves. We kind of talked about this last time y'all came on about family offices. I mean, are they hiring Netherlands Sewell to do reserves? Do they have in-house engineers?
They do. So,
and I get everything's going to be different.
It's usually kind of, I'll let Brad jump into, but it's usually small investment teams, even for large family offices. They will outsource some of the technical work required. They usually have kind of a go-to consultant maybe that they use, and they'll get them to look at it on their behalf. Then they also, our team, which is 3 petroleum engineers, 1 geologist, is ready to kind of help them move their evaluations forward, just like we would in a sell side. So obviously in a sell side, the buyer's going to have a full team, so it's more interaction, with kind of two different technical people of similar experience in a lot of cases. This case, you have usually kind of a financial team at the family office. They're kind of leaning a little bit on, a consultant relationship or two. And then they'll kind of come to us and say, hey, we need you to kind of do these runs or what have you.
So not that different than how a lot of the private equity firms worked. I mean, we we at Kane just had the engineers in house and all, but a lot of them would say, "Hey, we use Cawley or whoever.
Right.
Call this guy. We'll have them take a look." So
Yeah, I think pretty similar.
Yeah, I agree. And going back to what you previously said, yes, the BDRs for these look exactly like a sell side, same exact detail. And then to your point, look, we would, for a sizable deal, we would recommend the company get a third party reserve report first, take a look at that, iterate on that. And then typically our technical team kind of does the same exercise. So you kind of have a second opinion, on the reserves. And then that's where you kind of get into the anchor investor. Okay, who are you talking to? What's their background? And typically they will have an opinion on that as well, maybe even hire their own consultant. So by the time that we have talked to the syndicate, if you will, whether that's 20, 30, 40 families, you've actually had 3 separate layers of detailed opinions and analyses on the reserves and what those look like before that goes out to the market broadly.
I got you. So big picture, broad strokes, give me kind of a timeline of how this all goes down.
So it takes, a normal, if you want to call it normal, sell side is 3 to 5 months, depending on the market. I would say for a CV, especially if it's a bigger asset, you maybe have some complexity at the shareholder level, just number of shareholders, opinions, if you will, in the room. I would say you could probably double that, plus or minus. I would say they're in the 8 to 9 months, and they can even go longer. It depends on also kind of the prep work done ahead of time. Okay, do we need a reserve report? What exactly does the data look like? What's it telling us? So a lot of that is kind of done, I guess you could call it before the process, but it's a part of the process, at least from the company's perspective. So, but once you kind of have your data buttoned up, your information buttoned up, it's probably 4, 5, 6 months from there.
And what are the chunks of that? Meaning, like, I send out a book, I go to 20 that could serve as a lead, and then how do you kind of chunk up that 4 or 5 months?
Sure. So the first 2, 3 months are getting the data ready, getting your marketing materials ready, finalizing your diligence, kind of doing all the things that you would do, in office, with your company or client. And then, then you're kind of talking about, okay, what is the company's goal? And you kind of back into, okay, how much capital do we need? How much capital do we need now? What do we think the amount's going to be in terms of selling shareholders? Those are going to roll. You're trying to do the best you can to figure out what that number is going to look like. And then that dictates, basically kind of who you go out to. Look, we've seen everybody kind of do these a little bit differently. Our opinion is we've basically been recommending, why don't you go find that lead, investor first. That way you're not having 30 separate conversations around what's valuation, what's a new waterfall look like, what do all the different terms look like. You're basically trying to figure out, okay, who are the right 8 or 10, 8 or 15 groups that could serve as a lead candidate, one that knows, energy well, in this case, minerals and royalties. Another important factor is, okay, one that other families would know who they are, have a track record, have history, could be influential, on the syndicate, and of course, well respected by the market. Yeah. So it takes time to do all that.
Yeah, and that's kind of an obvious, extremely important part of the process, because the syndication, if it's a larger deal, that can add 9 months if you get the syndication wrong. If you get a lead that just isn't as strong with, their in terms of experience, kind of means the groups fall on them, maybe don't have as much conviction as they should have in terms of moving forward, and it can just fall apart. And then when it falls apart, you got to sub in people that sub in groups that replacing groups that left, and it can really add a lot of time to the process. So I know on Brad's deal, there's a ton of time kind of just really interviewing potential anchors and just getting a lot of comfort that the anchor was going to be a group that others followed. And it's real obvious, but we definitely seen situations where, you just have a deal, a situation where the syndication can add 9 months to a deal because you just didn't get it right. So
yeah, it was interesting. We just did a fundraise at Digital Wildcatters. Mercury stepped in and led our seed round of $5 million. And, we were blessed to have a lot of great oil and gas energy types participate. Billy Quinn came in, Dave Albin came in, Dan Pickering came in. But I remember sitting around here with Colin. It was like, well, we need to send these guys documents. If we send them too early, they're going to have opinions on those documents, and we haven't heard everything we need to hear from Mercury. So there was you kind of want to go with the binary offering, but you also can't jam it down in front of them, 48 hours before they got to close. Guess what? The Billy Quinn family office doesn't want to read something in 48 hours. And so you kind of got to be respectful of that. So.
Right.
Yeah, I could imagine all that. Give me something just crazy out of this deal that I never would have thought of. Was there anything wild that sort of popped up, or a twist or a turn or a lesson learned that maybe
there was some twists?
Yeah, there were some twists. Look, I would say that without getting into too much detail, that there were appropriate opinions as to how the balance sheet should look, coming out of the gate as it relates to having leverage, not having leverage, which obviously, factored into how much equity capital we needed to raise. And so there were certainly some opinions there from everybody involved, whether that's the management team, the company, and the new investors coming in. So that was a process trying to figure out what makes the most sense for this company at this point in time. The other thing too, this is no different than any other deal, but you've got gas going from $1.80 to $5 and back down, and oil going from 83 to 60 and back down. So, just these processes take long enough to where you kind of see 2 or 3, sizable shifts in commodity prices throughout the process. And so, like any M&A deal, you see the momentum kind of, ebb and flow in one direction or another during a process. And so no different here. It's just everyone that's done any type of transaction work in oil and gas land for the last 50 years understands that dynamic. And we certainly had it in this one as well.
So give me a thought. If somebody's out there listening, who do you want a phone call from? What does their company need to look like? And whether that's just flat out raising them family office type capital, or potentially doing a continuation vehicle. Is there a box?
Yeah, I think so. I think
typical banker, you're going to say everybody needs to call me, but
well, size wise for us, and this is probably just more for us. We kind of, I'd say 100 million of equity and up.
So that's the raise size.
Yeah, that's the raise size, and that's kind of a fit. We certainly have done smaller and would look at smaller for if it made sense, but hundreds and up is good, just because that you can get, given the size investments our family offices are making, you can piece together, call it 3 to 5 family offices and put together a nice syndication just around 100. It gets a little, if you get below that, you're talking 1 or 2 family offices, and it just becomes kind of less of a solid fit for our family office network. Geographically, like I mentioned, there's definitely interest in some of the secondary areas, if you will, like the Mid-Con, Rockies. So if you have a company focused in areas like that, no problem at all. Our family offices would have interest.
The Maverick Basin we could raise for if we needed to.
Yeah. Maybe not, but no.
Jim Sigmund shout out.
He's going to call, but they but definitely needs a set of assets. Can't be like I want 100 million to go chase these deals that I may or may not get. That doesn't really work. Need to underwrite around an asset valuation. Kind of obvious, needs to tie together. So can't be trying to get a premium valuation if it's not justified. The family offices do want to grow. They do want an entity that's going to grow. So you need to have upside that has some solid backup to it. So that's an important piece of it. The team, this is pretty obvious, but the more substance with the track record on the team, the better. I mean, that's a pretty obvious statement, but we see if they've been PE backed before, I think family offices look at that and go, hey, a real smart investor vetted this team. That means something to them. I think those are the main things. Again, the other piece of it, longer term holds for sure. They do like to build distribution vehicles. So they do want, it doesn't have to be big distributions out of the gate. It could be zero, but they want to see in
You're
the
paying
model,
a coupon to something.
that you're going to be able to get there and support
in real
distributions.
cash as opposed to an accrual.
I think those are the
The only thing I would add to that would be the existing company's ownership construct. So if you've got, again, you're trying to solve that problem of you've got some investors that are wanting to stay on, and then maybe some that are trying to get out for whatever specific reason. I would say that's the only thing I would add on to what Keith was talking about at the asset level.
Yeah, got it. Interesting. So you called me 2 years ago and said we're doing stuff with the family office. I called BS. You came on. You actually proved it.
right.
Now you said you can do a big, huge continuation vehicle. You came out and proved it. Next year you're going to call me and tell me exploration's back. Are we gonna be able to be that crazy?
So I'm gonna say probably not.
Okay.
But what I guess if I had to look out kind of how I think things are going to evolve, and it's just really hard to say. I do think family office equity is going to continue to be important for many years. I mean, last year was a really good year for in the PE fundraising world with what Quantum and InCap and NGP and Pearl and some others did.
I think Carnelian raised
Carnelian.
too. Yeah,
That's right.
So that's a lot of billions of dollars, right? And that's great. You want that. Our clients, it's good for them to have access to that type of capital, but there's a lot of capital needed, just in this CV space alone. And so we think we're going to continue to work hard to, develop our network. Hopefully when we come back, a year from now, we'll have a couple other CVs closed and kind of continue the roll
Can we
here.
do the next podcast from Duke's in London?
Sounds
That's
great.
great.
Yeah.
Yeah.
Have y'all been to Duke's yet?
I haven't.
I haven't either.
Yeah.
No.
Y'all don't even know what this is. Okay, so like if you do finance and you go to London, Duke's is the hotel in the middle of Mayfair, and it's got Duke's bar, and a Duke's martini is how you ultimately seal the deal with somebody from the UK. So they bring out the cart, they pour the I've actually got a picture. We'll throw it into they actually pour your martini table side. And it's such a big deal. You have to get a reservation to go to the bar.
We're going to do that. So so Brad and I, we've been over there a number of times. We're a little bit new to some of the stuff like that, but we did go to Annabelle's. And,
there you go. The only restaurant the Queen ate at.
Yeah. And so
Seriously.
Really? Okay.
So we were in there with a colleague of ours that had a membership or has a membership. And we thought it was really neat. And our colleague was meeting someone else, probably more important than we are for a drink. And so we were there for one drink, and then his friend comes up and it was time for us to leave. And so we made the mistake of, we went out the wrong way. And then we kind of ambled around for about 10, 15 minutes. We're trying to see if we could get out by just continuing to walk around the opposite side of how we came in, and we couldn't do it. And so
we had to go back in.
We had to circle back in front of our colleague and put our hand up and hope that he didn't see us. And we failed the IQ test getting out of there, but it was a really neat place.
Yeah, no, I've not been to Annabelle's.
It's amazing there. Yep.
Yeah. The other thing you guys have to do, being oil and gas guys, is over in Mayfair in what's called Pickering Place. There's a sign up for the old Texas Embassy. Have y'all gone to see that?
No.
You know what? Stevens needs to hire me as a consultant, maybe a Stevens alum.
Yeah.
And I'll come over and I'll show y'all London. I've learned a lot from Dayton Laura. So the other issue I have, and potentially the reason Laura and I get along so well, is I don't understand half of what she says. And half of it's just the accent is so heavy that I just don't pick up on it. The other half is they say stuff that I have no idea what it means. Like, that guy's a real onion sandwich. I'm like, what does that mean? And all their words for stuff.
One thing real quick. So Brad wears another hat, runs our A&D group. We have had a really good year last year. We're kind of focused on, call it $100 million to $1 billion deals, probably 100 to 300 is a little tighter range. And in market with a few right now, should have another really good year. Obviously oil deals are a little tougher right now, but we have a really, really good team. I mentioned 3 petroleum engineers, 1 geologist, all came out of industry. So we didn't hire them from other A&D shops. They kind of have really deep, industry knowledge coming from their prior experiences. So think of us for that piece of business too.
Gotcha.
Yeah, we're probably closing 8 to 10 deals a year there.
Oh, nice.
In that lane. So it's as Keith mentioned, we've got a great team, and we kind of pick our spots. We know we're not big enough to be all things to all people, but we definitely take kind of a partnership approach to sell sides. So
yeah. At the end of the day, where do you think valuations are in kind of the A&D market? And let's maybe peg a year past at the height of the shale revolution as like the drunken sailor at 2 a.m.
Yep.
Where are we these days in M&A?
Okay, so
and I will say maybe like 2 years ago felt like 1 times cash flow was a win.
Yeah.
So
this question's coming at an odd time, right? We're right in the middle of tariffs, and we've seen what the market's done the last 2, 3, 4 weeks. But if you kind of go a month and a half, 2 months ago, you had, basically kind of a increase both in oily M&A transactions and multiples, and also gas. But I would say in the last, call it 4 to 5 months, you've actually seen a little bit of separation on gas from oil. So the multiples that we're currently seeing on gas-weighted deals are probably a turn to 2 turns higher than what we're seeing on oil-weighted deals. And that's with the LNG, the AI, everything that's gone with that over the last, call it, year plus or minus. And so we've seen some separation there. So yeah, going back to if you look at kind of rolling cash flow, rolling EBITDA multiples, to your point, when shale was a frenzy, you saw things at 10, 12, 14 times. You're probably seeing assets trade for 4 to 6, 3 to 5, kind of depending on where you are and kind of, the construct of oil versus gas. Of course, it's super fluid right now, just given this tariff madness. And then obviously OPEC's news here a week or so ago is having an impact as well. So, but I'd say things that have closed up until this point have been in that, I know it's broad range, but kind of 3 to 6x.
No, interesting. So definitely better than 2 years ago. So interesting.
Well, I think most of the sellers, to your point, are saying, if I can only get 2x or 2.5x, I might as well just continue to own the assets.
Right,
and why sell it? And then just have distributions,
we
make
declared
distributions.
Bankruptcy. We cleared up our balance sheet. Why would we even sell?
Yeah, look, I would say that anything above 3.5 to 4 at least get sellers thinking, okay, this is way better than just holding something for a couple of years and taking on that risk. You're actually being paid to sell the asset that you're, like I said, moving that risk to the next person.
Yeah, I always, I don't think management teams always kind of fully appreciated it's, well, what do I do with the money? And so you're right at 2 times. Is that, do I have a project that makes me 4 times? Probably not that large. So to your point, you hold it.
Yeah. Well, and then you get that capital, and then you almost have to start over, right? And I think most people realize it's that first couple of years of starting that new company is the toughest.
Yeah.
And so you're already at that point, might as well enjoy that upside.
So this was great. Scott and Kim Sheffield were gracious enough to have me out to the ranch in Santa Fe a month or 2 ago. And I was out there on the porch, and sitting there staring at the Pecos River running right through it. And we were talking about the oil and gas business, and Scott said, you know what? I think this is kind of cool. You sell a company and then you go start over. And 40 years of running Pioneer, one person made me an offer for all the company. It was Exxon, and I gave it to him. He's like, I would have loved to start over. It was funny.
Oh, man.
So, cool, dudes. Appreciate y'all coming on.
Yeah. Thanks, Chuck.
Thank you.
Appreciate
Thanks for
it.
having us.